Hey guys, Nick here. I wanted to shoot a quick video real quick. It's pretty basic and just goes over the differences between tax sale overages and mortgage overages. Some of you probably already know, but I get this question quite a bit. What's the difference between the two? So I figured I'd just shoot a quick video about it. To help me, I lovingly refer to mortgage overages as MOs and tax overages as TOs. So remember that, MOs and TOs. MOs, or mortgage overages, is when an overage has been generated from a mortgage foreclosure sale. And so basically what happens is the homeowner, they stop making their mortgage payments, and so the lender initiates a foreclosure. Usually they hire a third party known as a trustee to conduct the foreclosure. This is usually a law firm that does it. And the law firm goes ahead and conducts the foreclosure auction. When a third party buys the home at auction and buys it for more than what is owed to the lender, that's what creates the overage. There are some times when a home will go to auction and it will not sell to a third party investor, and the bank will then take possession and resell it. When that happens, an overage cannot be created. So sometimes I get homeowners that call me and say, hey, I lost my home in 2016. I just looked on Zillow and they sold it for, 200 grand and I only owed 150 grand. In those cases, what most often happens is their home went to auction and a third party did not buy it. And so the bank took possession and then they remarketed the home through a realtor and resold it. In that instance, even though they only owed 150, the bank took possession back. Basically, the bank bought it back for what was owed, and then they resold it for much higher than what the original loan was for. When that happens, there is no overage. It's only when a property sells to a third-party investor that an overage is created. So that's mortgages. TOs, tax overages, is when a property is sold at an auction because the homeowner has failed to make their property tax payments to the county. And so when this happens, usually the county is the one that conducts the auction. And if there is, say the amount of taxes owed is $10,000, and an investor comes in and purchases the tax deed for $50,000, then there's a $40,000 overage. And that's the main difference. You're just dealing with different entities. With MOs, you're dealing with lenders and trustees. With TOs, tax overages, you're dealing with county governments in most cases. There are some different details that I could go into, but that's a little more advanced because there are different types of tax sales. There's tax deeds and tax liens, and that plays a significant role in how the overage is created and what you can do to recover it. But that's a different video that I'll make. But yeah, hopefully this is helpful. Hopefully this explains a little bit between how an overage is created and also the difference between MOs and TOs, or mortgage overages, and tax overages. If you have any questions, leave a comment below. Let me know. Let me know what other things you would like to know about recovering overages for people, and I'll do my best to shoot a video. The online coaching group should open this month, probably within the next week or so. So stay tuned for that. I'll post a video when that happens, or you can also send me an email and I'll keep you in the loop when that opens up. That group, what is the group going to consist of? Basically, it's me teaching the steps on how to do mortgage and tax overages. And it's also a place where people can come and ask specific questions and get specific answers. And if people are stuck on a deal, they can joint venture with me and my company on overage deals. So that's only within the group. So if you want to be updated on that, I'll post a video, or you can email me, Nick, N-I-C-K, @overagerefund.com. So again, post any questions. If you like this video, please share it, comment. Would love to know your thoughts. Thanks, guys.